today we're going to talk about tax game planning in retirement. And we have a couple of real life examples to give for you, along with some additional information. I also have, if you need any of the information that we are going to talk about today, I have the tax tables for various situations pulled up that we'll reflect on during the conversation. If you'd like copies of those, you just send me an email. Our compliance department does require that we send this for approval before we can send it out as a recording. But when they do approve it, we will let everyone know that it's available to rewatch again. So with that being said, let's kick things off. Dad, are you there? Ready to go?
Yes, I am. I'm ready to go. Individuals planning for retirement all have similar concerns, and one of them certainly is taxes. So for most of the literature that you're either receiving or viewing on the internet, or you may be hearing over the TV or radio, a lot of this attempts to, we think, instill a little bit of fear in retirees by saying that taxes are going to go up in the future and that taxes can be a roadblock to retirement. We don't agree. We know that taxes can go up in the future, and we think that individual income taxes are really a political football. But we know that historically they've gone up and they've also come down. So it's sort of like inflation. It's going up, it's coming down, it'll go back up, it'll come back down. We do know, however, that unlike other assets of your life, planning for taxes is one that you really can have a lot more control over.
That's right. And, we really take a different approach to tax planning in retirement because we feel like it's going to be great. During your working years, it's difficult. And in many cases, it's basically impossible to control your taxes. And the reason for that is the majority, if not all of your income is considered earned income, primarily from wages from work. And when you're working, all you want is more income, right? So you're willing to pay the taxes to get the raise or the bonus. But in retirement, you have a lot more control over your income because for most people, you don't have wages any longer or earned income.
And, just as an example, some examples, we know the Social Security benefits are subject to a maximum taxable amount of 85%. So 15% of your Social Security benefits are always non-taxable. And you see that most of your experience of that when you're filling out your taxes for the year. And maybe more importantly, and I guess kind of our mantra, our core planning concept is that we're only going to plan to fund to your net pay, the amount of income that you need, obviously not your gross pay. Because we know that if you remember your old gross pay, if you are retired or if you're not retired at this point, you know that your gross pay, you're typically only bringing home about 60% of that. And that's because you don't have taxes being withheld, whether it's FICA, whether it's retirement plan contributions, whether it's healthcare contributions, the United Way, whatever it might be. So that's important. And with that in mind, we find that all of our clients, every single one of them, is either in the same tax bracket or in a lower tax bracket than they were working. And so what our job is, and we frankly find the fun of it is that depending on the configuration of your assets, how much you have pre-tax assets and after-tax assets, what we can then do is we can moderate those taxes by creating a cash flow game plan that we believe is and can be tax efficient.
And really what we'd like to do this morning is use two different examples to demonstrate how we and how you can effectively game plan for taxes in retirement. The first example is basically an ongoing strategy for tax planning in retirement by reviewing a cash flow projection that we developed for a newly retiring client. So this is someone where, they're retiring, they want to make sure that they can live the same lifestyle the day after they retire as the day before. How do we meet that income? What is that income need, and how do we meet that? What will the tax ramifications be of that? And then the second example is one in which we are going to plan for taxes during extraordinary events. Now, some extraordinary events, we just have to pay the taxes because the need is immediate. The money is coming from a taxable account. Sometimes we can't always be as efficient as we'd like. But in the cases in which we can be efficient, we're going to try to do so. So the example that we're going to use for the extraordinary event is a client that is interested in paying their mortgage off at an accelerated rate, as opposed to just saying, I'm going to take a lump sum out of my account and pay it all right now. How can we effectively shorten the amortization of the mortgage schedule, but also contain the tax ramifications of having done so?
So in our first example, John is 66 years old. And he has been a lifelong sales rep with a large private local company. He's been a good saver, and he's been able to accumulate, and frankly, also a good investor, about $1.7 million in his 401k plan. His wife, Sarah, is a couple years younger. She's 64. And she had been trained as a nurse. She worked briefly in that profession and basically became a stay-at-home mom, helping the kids grow up. She had an IRA, or she has one, of about $65,000. And being smart, John and Sarah have been putting money into a Roth IRA for her, which she has about $85,000. They also have about $45,000 in savings at their local credit union. We call that the vault. So between the two of these, they really have about $1.8 million of pre-tax savings and about $85,000 of tax-free savings. So let's take a moment and talk about some of the game plans that they asked us to address. The first one was, and maybe the most important one, is the retirement income game plan.
Exactly. So when we were chatting with John and Sarah, they let us know that they really need about $6,000 a month after taxes in order to make their lifestyle work. So we know that we're going to gross that up by about 20% for taxes, which is a little bit high in their particular case. However, what we find is that when we build in a little extra for taxes, that in many cases becomes the buffer for many of our clients when we experience inflationary times, or just during the changes that your lifestyle will have from when you were working to retirement. We don't usually quantify the cost of going to work because in many cases we find that clients replace those expenses, as opposed to buying lunch every day while you're at the office. Maybe you're going out to eat a couple times a week with friends, so on, or you've picked up a hobby, so on and so forth. So what we're trying to do here is just build a little buffer. So when we gross the $6,000 up for taxes, we know that they need about $7,200 a month. When John and Sarah become Medicare, Social Security eligible, John's going to have about $2,900 a month of Social Security, and Sarah is going to elect the spousal benefit of $1,450 a month. So she's going to take 50% of John's benefit. So that means they're short about $2,850 a month when they both reach normal retirement age.
So the $7,200 per month of income puts John and Sarah into a 12% effective taxable. Okay. Again, we assume that all of that income is taxable. But we know that when they reach Social Security eligibility, 15% of that, basically $4,350 a month that they're receiving, will not be taxable. And that'll also reduce their income tax liability. So while John was working, and his income was even higher, and even though he was making contributions to his plan, his 401k plan, their effective tax rate at that point was 22%.
And you know what I thought would be a little helpful is I'm going to share my screen instead of you all looking at my face, to show you some of the tax tables here, so you all can get an idea of where you might fall. One quick second, let me pull those up. Here we go. So for 2023, I have the federal income tax brackets for both single filers and if you're married and filing jointly. So you can kind of see right here that John and Sarah are going to be below that $89,450 married filing jointly limit on the 12% tax bracket. But just like my dad said, he said effectively they'll be about 12%. Well, or marginally rather, they'll be at the 12% bracket. Most people also forget that because we have a progressive tax system, that means that the first $22,000 of income for John and Sarah are only going to be taxed at 10%, which will effectively bring down that 12% when you look at the total taxation for the year. So when you're looking at where you fall on this bracket here, just keep in mind that you want to factor in each level that you progress through. And unfortunately, the last dollar that we earn or the last dollar that we consume if you're retired, if you're retired, is always the most expensive dollar. But that doesn't mean that every dollar is taxed that way.
So, honey, I know that that you had a question that also came, what was involved here with Roth IRAs. Is that correct?
That is right. So we received last night, an eager listener sent us a great email question about taxes. And her question was essentially, how do we know if a Roth conversion is right for us? Is there a formula that they're out there that we can just plug and play to figure it out? And what I thought would be a great idea is, let's use John and Sarah as an example. Does it make sense for them to potentially use a Roth conversion in order to bring down their taxes when they get to required minimum distribution age? And many of you have probably heard this, that the age has been pushed up a couple of times over the last several years. It used to be 70 and a half, then it was 72. And now just at the end of last year in December, the age has now been increased to 73. So this is not a short-term concern for John and Sarah in retirement, but it could become a long-term concern in terms of having to take required minimum distributions. So what I did was I said, let's assume no growth inside of John's retirement plan assets. So he's got about 1.7 million. That means that when he turns 73, his required minimum distribution is going to be about $70,000. The first thing to keep in mind that's important is John and Sarah are already going to be taking about $34,000 a year out of their retirement accounts to make their lives work. Because if you remember, once they begin taking Social Security, they have a deficit of about $2,800 a month. So over the year, that's going to be about $34,000 for the year. So that means there's going to be an excess distribution, or a distribution that they wouldn't necessarily be consuming if the government didn't require them to remove it from their retirement accounts, of $35,800. If we jump back to the tax table and see the first $89,000 for John and Sarah was between the 10 and 12% bracket, this is going to bump them up to the 22. However, all that means is for that year and for the subsequent years, they're going to owe about another $8,000 in taxes, which, I mean, is a little painful, but it's not nearly the tax burden that is often perceived by the requirements for required minimum distributions. And I think that the piece that a lot of people leave out of this conversation is most people in retirement are consuming some of their IRA assets in order to make their lifestyle work on an ongoing basis. So these are taxes that not only were you paying before you got to 73, but you've been paying them ongoing throughout your retired years. So John and Sarah are going to be paying taxes on, you know, the $34,000 between 67 when they plan to retire and 73. Now we are going to add a little on top, but it's only going to be about another $8,000 of expense for them.
Yeah,
If
and
okay.
honey, I was just going to add to that. For those folks that that are getting ready to retire, or if those that are even already retired, there is a notion out there, or just a feeling that the level of required minimum distributions as a percentage of your total pre-tax assets is large. In fact, it's small. I believe that that at age 73, the initial percentage, if we want to convert it from the IRS table, is less than 4%. So with $1.7 million, again, as Aaron was making that point, is that they have to pull 4% of that, not 10%, not 15%, but only 4%. If we're staying in these, even if adding a little bit extra gets you a little more taxes, does it make sense to pay more taxes before they're due? And I would say that, you know, my answer is no. And interestingly enough, and as all of you know that are clients, and if you're not clients, if you have investment accounts, things tend to go down from during 2021, okay, or 2022. When it came to do required minimum distributions for this year, most of our clients actually, even though they were a year older, and the percentage that they had to take up went out, and it went up, and again, it only goes up incrementally by a couple of tenths of a percent per year. They actually had lower required minimum distributions this year than they did last year.
Right, because the required minimum distribution is not a fixed number. It's calculated in two ways. When you reach the age of 73, you're going to look back at your account values on December 31st of the previous year. You're going to multiply that number by, I think it's about 3.85% is what the initial distribution requirement is. However, the custodian that you work with, or if you happen to, I'll send you a letter that lets you know the amount that's required to take. If you're working with us, we give you a call, have you come into the office, we talk to you about how much you're required to take versus how much you are already taking. So for example, if we were having that conversation with John and Sarah, we'd say the requirement's about 70,000 for the year. However, you're already taking 34,000. So we know that we've got a $35,000 differential to make up here. How do we want to do that? If you're, you know, we're going it on your own or you're working with someone else, you'll receive those letters in the mail to you that'll let you know your annual amount. And because both your account value is going to change from year to year and that percentage slightly increases from year to year, every year it's going to be different. And just like my dad mentioned, because we had started to see the drawdown in the economy and the pullback in the market before December of last year, account values were lower than December 31st of the previous year, helping a lot of clients in the sense that their distributions ended up being a little bit lower than they had anticipated, which is always nice. When you're considering Roth conversions, unfortunately, there really is not a formula that you can plug and play with. However, I would recommend taking a screenshot of this, or you can see the taxfoundation.org 2023 brackets up in my search bar here. You want to take a look for that. You want to consider, number one, like we talked about, the last dollar that you consume is going to be the most expensive. When you're converting from traditional IRA to Roth, you got to pay the taxes. So if you don't have the taxes to pay outside of the IRA, you're going to have to pay those with the funds from the IRA. And if you say, okay, I want to convert 100,000, if we use John and Sarah's case, they already were consuming about 89,000 in terms of need for income to make their lives work. If we added another 100,000 on top of that, we know that essentially would all be taxed at the 22% tax bracket. Is, do we want to pay $22,000 on 100,000 simply to convert, or does that 7,800 sound a little bit better of ongoing taxable expense? I would say that's probably the most effective way to take a look at if a Roth conversion makes sense for you.
That's great. And again, if you do have questions, we'd love to take them, but compliance won't let us take them verbally. So if you want, you can always send Aaron a email at aaron@jblfinancial.com. Or if you like the more popular email, it used to be anyways, jeff@jblfinancial.com. I'll check my email as well. So topic number 2, and again, this is a big one in retirement planning, which is how do we deal with, we'll call them distributions that are in excess of normal operating expenses or income. One of the most popular questions we're asked is, should I pay off the remaining balance on my mortgage? And we're going to go through an example on this. But at the same time, we also have other questions, which is, how do I deal with this home renovation? How about the purchase of a new car? How about the down payment on a second home? How about a down payment on our kid's first home? Lots of reasons that we might need large amounts of capital. And naturally, we love receiving these questions because, frankly, as planners, this is the fun. The tax code is set up in such a way that in understanding these tax brackets that we have, understanding where you are in the system, what we hopefully can do is talk about, and as I've coined the phrase, turning on and turning off faucets. Where do we draw the money from, and how do we do it in the most meaningful way? And I know that, Aaron, we've got a really fun example of Joe and Sally, our 14th cousins of Joe and
Right.
Sally, that we love to talk about on the show, paying off the mortgage. And this really can be generalized, I think, to just about any other large expenditure, whether it's, and we love paying for weddings. That's the other thing, is our clients, their kids are getting married. We love paying for weddings. I'd love to pay for a wedding. Thought I'd throw that in.
Right. Right. Can never get away from that. Thank you. Well, and what
you're
I
welcome.
have heard is that wedding expenses can be a multi-year undertaking in terms of planning, because sometimes there's down payments that you have to, or deposits that you have to make, and then you're paying off balances at a different time, or I've heard from some of our more progressive clients where they're now splitting the bill, like the daughter's family doesn't pay 100% of the actual wedding ceremony anymore. Usually the husband or the son is now, their family's also participating. So maybe you have a split arrangement. Or the other thing that we're often talking about, especially now because car prices have gone up so significantly, how do we pay for that car? That's a pretty large expense, and a lot of people don't love carrying debt or having those car payments. But does it make sense potentially to carry the car note for a couple of years? Because I've started saying, when I really thought about this, is you're always going to pay someone. Either you're paying the bank in terms of interest, or you're going to pay the government in terms of taxes. So who can we give the least amount of money to? And when we're usually comparing interest rates, especially if you have decent credit and you're looking at car notes or mortgages, interest rates still seem to be significantly less than tax rates. If we're comparing a 5% car note, which is a relatively high, versus potentially 22% in taxes, well, let's do the lesser of two evils in that example.
Okay, good. So let's start with our discussion about Joe and Sally, shall we?
Absolutely. So Joe and Sally have a mortgage payment of $1,000 a month. They're not escrow. So this doesn't include taxes or insurance. They don't escrow. So we're just looking at that flat $1,000 a month payment. And their remaining mortgage balance is $80,000. If they continue on the current track, their mortgage should be paid off within the next 10 years. Because most of each payment is now allocated to principal as opposed to making those interest payments, what you do at the beginning of a mortgage. So let's first look at how much capital does it take to sustain the monthly mortgage payments. We have $1,000 a month mortgage payment over 12 months. If I had a lump sum of capital and I wanted to live off of the interest and the earnings of it without depleting the original investment, we would need about $300,000 in order to do that. And if we remember, the original obligation, it only has about an $80,000 balance remaining. So why keep $300,000 of their assets tied up simply to pay this $1,000 a month obligation?
You know, honey, that makes sense to me. And certainly we've recommended that it feels good. It'll make you feel better not having these monthly payments. Why keep this capital tied up? Let's get rid of the mortgage. But when we look at that, we say, okay, oh my God, if we did a lump sum one time of 80,000, we really would have to gross this up to 96,000 because of the taxes that are due. This also could, in this particular case, having really negative impact on the Part B medical premiums that these folks are paying. It could move them up into a new bracket, and this unfortunately is really, if you think about it, higher Medicare Part B premiums, especially if you cause them themselves, is really an additional tax, which will go on for a year. So that's the first thing. If we're not going to do it as a lump sum, maybe what we can do is shorten the duration. So let's consider increasing our payment to reduce the length of the obligation. Naturally, what we would try to do is to, if we can, is to piecemeal this out over a 2 or 3 year period, possibly, so that we're not increasing the effective tax rate, but at the same time, and also not affecting their Part B premiums, maybe, to get this done. And I guess the final thing that I would certainly consider, I know it's a question that we're asking folks, is how long do you plan on staying inside your home? And that's a bit, you know, that really is a big deal, because obviously the more that we tie up into our home is really non-income producing capital. How do you get money out of your home? There's only 2 ways. You either borrow the money or you sell your home. So rhetorically, I guess you can ask the question, do you ever really own your home? I don't know. So when you get to a point where you're not able to itemize your deductions because the interest expense that's involved, and God willing, you don't have high medical expenses, aren't sufficient so that you can itemize your deductions, this really does become a real option that should be considered. And really this, I was going to say this again, this decision of paying something off, a large obligation over a period of time, is certainly something that if we can, we want to apply to other large expenditures. It isn't, you know, many of our clients are making the decision that their home that they're living in is really going to be their retirement home. So that being the case, sometimes they decide it's time to spruce it up, whether it's replacing those kitchen cabinets, redoing a bathroom, turning Junior's room into a gymnasium, whatever it might be. This can take large amounts of capital. If we're able to split up those capital needs over a 2 tax period, and as Aaron likes to say, we send you money on December 31st and we send you money on January the 2nd, what we can then do is effectively deal with that cash need, and at the same time, maybe
and you know
be a lot more effective in terms of how we pay for taxes.
Absolutely. And I just wanted to, you know, bring everyone back to that tax table again and just say that let's assume that Joe and Sally needed about $100,000 a year of taxable income to make their lives work. So they were already in the 22% tax bracket. With $100,000 of income, we know that they have almost 90,000 more to go before the next bracket. You could theoretically take, 40,000 per year. Remember, you might be thinking, oh, well, they could do it all in 1 year because they've got 90,000 of room. However, they're not going to net $80,000 in the first year in order to pay the mortgage. So if we broke it up even over a 2-year period and say, let's net 40,000 a year, you can pay it off in 2 years, we would keep them in the 22% tax bracket. And now I'm going to flip to my next table, which is those Medicare Part B premiums, which show you that, you want to be at $194,000 or less married filing jointly if possible, because that's going to keep you at the Medicare Part B base premium. So this adds another layer to tax planning in retirement, but it doesn't make it more complicated, because you all can write down these tax tables or save these websites and update them on an annual basis. And all you have to do is take a quick look to pinpoint it, which is, all right, even if we sent Joe and Sally another $60,000 that year in order to net them about $40,000 to pay half the mortgage off in the first year, well, they'll still stay in the 22% tax bracket on the federal income table, and they'll be below the $194,000 married filing jointly to maintain consistency in their Medicare Part B premium. So it does take a little bit of planning and a little bit of long-term consideration. But what I would say is that it's really nice to be able to, now not only can you control your income, you can attempt to control some of your taxation, but you really get to take a handle of, we're going to have ongoing debts throughout our lives. The last time you pay off the mortgage won't be the last debt that you have. We've had many clients that pay the mortgage off and then they find a vacation home, or like my dad mentioned, maybe they're still helping kids pay for expenses, or they want to help kids pay off expenses now that they feel that they're in a great place in retirement. So there are always situations that come up that are going to require capital above and beyond what you might need on a monthly basis. And being able to control or mitigate your taxes, or control and mitigate ongoing interest payments, because essentially that's what we're effectively trying to do by paying the mortgage off faster, is, one, get rid of the monthly expense, but two, limit how much we're paying to the bank in terms of interest. We can do that over a long period of time with a little bit of legwork on the front end.
Honey, is it possible, could you pull back the tax table back up for us?
Absolutely.
Okay. I just like to make 2 points here. The first one is, and folks, you know this, and so I'm going to apologize for reminding you, but in a progressive tax system, when you moves you into the higher bracket. So as an example, when that $9,450 first dollar, that $1 that takes you into the 22% effective bracket, that's only marginal bracket. It doesn't mean that every dollar that you had earned all the other 89,000 then gets subject to 22%. It's only each dollar that's above that 89,450 is subject to 22%. So when we talk about you're in the 22% bracket, you're only talking about a marginal bracket, not an effective bracket.
Right. So if you think about it, the 89,451, the $1 you're going to pay 22 cents on versus the previous dollars that were at the 12 and 10% rate. So a quick way to do this, Dad, the line, I think you even know the lines on the tax return, to take a look at what was your gross income versus how much you paid in taxes, divide that, and you'll see that no one is in the marginal bracket for 100% of the income that they have consumed.
Yes, and to be real and to be very specific here. In the second bracket, when we're looking at married filing jointly, 67,450 of that income is subject to the 12% rate, which is 2640. If I add that to that 2640 to $2,200, which is 10% of the first 22,000, that means that someone earning 89,450 is actually only going to be paying, oops, I hope I did that right, 67,000 times 12% is 8,000, I'm sorry, plus 2,200. If I take $10,240, which is actually the total tax that would be paid for someone that's earning 89,450, their effective tax rate is only 11%. So when we start adding more money, and if they go over that 89,000 level, even though those dollars themselves, those additional dollars are taxed at 22%, it's only going to increase the effective tax rate slowly. So doing these conversions is something that we have to look at. Pulling money out of retirement accounts is something that we have to look at very carefully, because again, we can obviously affect Part B, but at the same time, at the end of the day, you're going to be in a lower or equal or a lower tax bracket when you retire. So taxes are never an issue. And frankly, we're Americans, so we know taxes aren't an issue, which is good. Honey, did we have any other questions at this particular moment that, that you might have received, or anything you wanted to add?
I didn't see any additional questions come in. However, everyone is more than welcome to, after the webinar, send us a quick email if you have any specific questions, or if you want to schedule some time to chat about your specific situation. You can always send us an email, Erin, E-R-I-N, or Jeff at jblfinancial.com, or you're more than welcome to give the office a call, 314-863-0008. Kelly, our office manager, will be happy to get some time on the schedule with us so we can chat about your situation specifically. And before I close out our chat, and I'll still give everyone a few seconds if you have a last minute question to get in, I do have to, for housekeeping, read that securities are offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. These are hypothetical situations based on real life examples. Names and circumstances have been changed, of course, to protect the innocent, and the voices and the opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what investments or strategies may be appropriate for you, please consult your advisor prior to investing or making any tax decisions. You are also all welcome to listen to us on Saturday mornings on KTRS, the Big 550 at 9 a.m. I see many familiar faces, so I know that we have some listeners, some clients tuned in, but if you happen to catch our webinar ads somewhere else, Facebook, Twitter, or Google, then please, if you like what you've heard, then you can hear a lot more of us. We're on every Saturday morning, 9 a.m. on KTRS for 2 hours, so from 9 to 11. We take live questions then, and the great news is you can call in or you can text the radio station during our 2 hours with you, and we try to get to every single question during that time. So we really appreciate everyone taking a few minutes this morning to join us. Hopefully you picked up a few tips and tricks, and we hope we plan to continue this webinar series with different topics. So if you happen to have a topic in mind that you're interested in, we love recommendations because we really feel like this is services that we provide to you to help you feel more comfortable as you either transition into retirement or you continue to enjoy your retirement.
Thanks for your time, folks. And we just say, have a great day.
Absolutely. Have a great day.